There are a number of things that impact growth markets. So growth markets consist mainly of shares and property. So those kinds of investments that can appreciate in value over the longer term. And a lot of them are, underlying fundamentals. Is a company making profit, and is that profit growing? If it's a property, is rental increases in place, and are they good quality tenants? Are there ways to add value to the property? Things like that. But there's also some things that aren't really in the control of those companies and those properties that can still impact their value. And one of those is interest rates. So the growth markets have had a really good run over the last few years, and COVID aside, they have had a good run. Now, one of the reasons for that is reducing interest rates. So people that invest in things like term deposits or fixed interest kinds of investments, they're impacted most of the time by changes in interest rates. So if interest rates go down, the amount of money or interest that they can expect to generate from their fixed interest investments goes down. Nobody likes that. Everyone wants to see their returns continuing on strong. So if it goes low enough and those assets aren't performing the way that the investor needs them to, they can look elsewhere. And generally speaking, if you're not looking at fixed interest or cash, that's when you turn to the growth markets. So while interest rates have been coming down, money has also been leaving that area and going over to growth markets. So if there's more buyers in a market as well, that can help push the prices up too. So that's one of the things that isn't really in the control of a company or a property that can still have a big impact on its value. Thanks.